Okay, I'm going to explain about the income statement and balance sheet. So these two are the financial statement, the most important financial statement which are used in financial accounting. And these financial statements are used by all the companies, whether those companies are small scale industries or the large corporation. Whether these companies in the form of sole proprietorship, partnership, or corporation doesn't matter. These two statements are used in all of them. So I'm just going to explain the benefits, means uses and limitation of these two statements. No doubt there are two more statements, cash flow statement and statement of change in equity, so that we are not discussing here today, but we are going to discuss about these two. So if we talk about the uses of the income statement, and first of all, income statement, I would like to say exactly we can say profit and loss account. We can say income statement, we can also say profit and loss account. And there are two sides of income statement, debit and credit side. On the debit side, we put all the expenses, and credit side all expenses, all income. Income minus expenditure is equal to profit. So once with that we prepare the income statement. So the first benefit is the profitability analysis. We will be able to know how much profit the company have earned. Like we can say it shows that how much revenue of the company is earned during a specific period of time, and it's related to expenses, because expenses, if you say expenses that will be on the debit side. And if you talk about revenue, so revenue that will be on the credit side, right? And that also help the stakeholders. So stakeholder here means maybe outsiders, bankers, uh, creditors, debtors, and maybe income tax authorities. All these are the stakeholders, and these stakeholder assesses the company's profitability. For example, if the company earned $500,000 in sales revenue and had $400,000 in expenses, the net profit would be sales minus expenses. That will be $100,000. So this is the profitability analysis. Second is the performance evaluation. The benefit of the profit and loss account or income statement is to evaluating the company's operational efficiency, which is very very important. Sometimes there are some technical word that we ignore, but we should not. Operational efficiency. So operational efficiency says that during the operation, during working of the business, the main core business, how much that we can earn. That is the performance evaluation. So that will be performance can be compared last year figure with this year figures, right? So comparing the income and expenditure over time. For example, if a company's cost of goods sold increased while revenue remains constant, it indicates inefficiency or rising the cost. So, what is the cost of goods sold? The cost of goods sold is those goods which are sold during the period of time, and what is the cost of these? For example, cost of mobile phone sold, cost of furniture sold, right? Furniture is sold, that comes on the credit side of the profit and loss account, and that much of furniture is sold. What is the cost of that furniture sold during the period? Maybe a quarter, half year, or year. Next is benefit of the income statement is to take decision. It helps investor management creditors in making informed decisions such as investment, lending, or improving the cost structure. So with example, I'm going to explain the high interest expenses may suggest to investors that company is heavily leveraged and guided them to reconsider investing. Okay, so in the financial statement, the interest expenses is also very very important. As an investor, the people will look into this high interest expenses, and they may not, or maybe take investment or make an investment in this company. So this is also one of the non-operating expenses, interest expenses. So operating expenses are different expenses, non-operating are different expenses. Non-operating expenses is that interest that you have to pay on the loan that the company have taken, irrespective of whether the sale is high or low. So that is non-operational expenses. Now, taxation purposes, it helps to find the taxation income, which is very important for calculating the company's tax liability. So this is also one of the things, like net profit is $200,000 and maybe taxable under the corporate tax rate, right? So this is also one of the important factor. Whatever the rate, every province have a different rates for to calculate the tax on the profit.